Fire your banker. Have you ever wondered how banks do it? How can they remain profitable when the rest of the world seems to go through the ups and downs of the economic cycle, right? What if you could do what the banks do with your money? What if you could become your own source of financing and take back control of your financial future? Today, we're going to talk about that chance for you to do exactly that. And this is just one of many webinars that's happening for the W2 Capitalist community. To find out more and to register for the upcoming webinars, go to w2capitalist.com/webinar. The link is going to be in the description below. Due to the guy I'm about to introduce you, I am on my way to fire my banker and never have to worry about anything that deals with a bank. But Mark, let me formally introduce you, and then I'm going to turn things over. We've got a few folks still trickling in and watching on Facebook as well, but we're going to get into this, right? So Mark Willis, CFP, I'm happy to call him my CFP, is a man on a mission to help you think differently about your money, your economy, and your future. After graduating with 6 figures of student loan debt, excuse me, and discovering a way to turn his debt into real wealth, as he watched everybody lose their retirement savings and income equity in 2008, he knew that he needed to find a more predictable way to meet his financial objectives and those of his clients. Mark is a certified financial planner, a 3-time, I don't know that I knew this, a 3-time #1 best-selling author. I need to talk to you because I'm writing a book. I don't know that everybody knows that. I'm writing a book. Anyway, back to you. Mark is a certified financial planner, 3-time #1 best-selling author, and the owner of Lake Growth Financial Services, a financial firm in Chicago, Illinois. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with proven tax-efficient financial solutions. I love this line. He specializes in building custom-tailored financial strategies that are unknown to typical stock jockeys, attorneys, or other financial gurus. I think you should put financial gurus in quotes, in air quotes. I saw one of the gurus, I'm not even mention his name. I despise this guy because I've seen him everywhere and all this stuff. He was on with Grant Cardone, and Grant was giving him all these accolades, and most people, if they're in real estate, they know who Grant is. But somebody released a video the other day of him. He was interviewing somebody for his podcast or whatnot, and they asked him, "Hey, how do you calculate cap rate?" And he didn't know. He did not know how to calculate it. And he fell back on the excuse of, well, I don't teach my real estate investing courses. I hire somebody else to do it. And then the video I was watching cut to a clip of him teaching a real estate investing course. I was like, yeah, you're a guru. All right. You sure are.
Wow.
But anyway, before I turn it over to you, I want to mention your podcast. You have an amazing podcast. It's called the Not Your Average Financial Podcast, where you share some of your strategies for investing in real estate, paying for college without going broke, and creating an income in retirement you will not outlive, right? So Mark works with people who want to grow their wealth. I'm going to raise my hand. That in ways that are safe and predictable to become their own source of financing and fire our own bankers. I don't know if you understand how much I loathe banks. Like even this morning, I had a banker reach out to me and it was telling me all the things. I was like, you know what? You should come to the webinar that we're hosting today, and gave him the title of it. I didn't do that, but I just ignored the message. Anyway, Mark, I want to turn this over to you and let people understand and know kind of what you and I are doing and why I engaged you and what I engaged you. Please use me as a reference as much as possible because I want this to be educational for everybody. And because this is a concept that I beat around the bush for like 3 or 4 years. And then finally you came on the podcast and I was like, ta-da, I'm doing it. I'm doing this with Mark. So hand it over to you, sir. Take it away.
Love it. Well, you're right, man. I think we've got an amazing group here, and I can't wait to talk through some strategies that might be counterintuitive to the average Joe. But as I say, we're not your average financial Joe here. We're going to be weird in a good way. If average means being beholden to our generous bankers, we're in big trouble. Because as we get into it, guys, we're going to learn just how much profit banks can take off your back. The harder you work, the more they profit. That's the unfortunate reality of how banks work these days. I am going to be interacting as we go. I will keep the chat box up as best I can to see it. But Jay, as we talked about, interrupt me if
Yeah,
I
I
keep
will. I
rolling,
will.
and if there's some good questions, you just keep me front and center on that. Right on.
Absolutely. And I
So,
will, guys, if you have a question at any point in time, drop it in the chat box. I'm going to turn my camera off so I don't, I'm not a distraction because there's no telling what may happen. Kids may come in here and whatnot. But drop a chat in the chat box or send it to me individually, send it to everybody. I want to make sure that you get your question answered and that you don't forget it because Mark, if I know, and I haven't seen this particular presentation, but if I know Mark, he's going to load you up with information, and 5 minutes down the road, you may not remember that question. So make sure you put it in the chat, and then we'll make sure we get it, and then we'll have a Q&A at the end. But make sure you make
and
sure you
some
get it in the chat.
prizes.
Okay.
I really thought about
Oh.
doing some Zoom bingo, but I couldn't pull it together in time. So in the meantime, we're just going to have some fun prizes, Q&A, live pop quizzes. So guys, keep your hands on that keyboard and keep your eyes where we can give you
Awesome.
that prize, eyes on the prize, and we'll go right through this as fast as I can to get it to any questions that you guys have. So let's jump into it. Who's this for? I want to make sure you guys are in the right room. First of all, I think anybody in the real estate space is going to find value in what we're going to talk about together here today. Mainly, the people I have worked with in the past through Zoom calls, just like this one, or one-on-one phone calls as a certified financial planner. We work one-on-one in an advisory role with investors, specifically real estate investors. And we specialize in working with the folks just like you guys and the folks that you see on the screen here, whether you're into property flipping, buy and hold, the BRRRR method, commercial, residential, whether you're into liens or even mortgage note investing, syndication deals, or even if you're just dabbling, if you're just kind of dipping your toe or your first two toes in the water, so to speak. I hope to give you guys at least 3 strategies and actionable tactics for becoming your own banker. And we'll learn why being your own banker is the small hinge that swings the big door in your financial life, more so than what you got on your 401k's account statement last quarter, more so even than how you sell your real estate or buy your real estate is who is controlling the banking function in your life. So we'll talk about why that's so important. Again, I won't waste too much time on this slide. You guys already heard Mr. J give a kind of an overview of who I am. But we love working with folks just like you guys. So let's jump into it. If you can't stay to the end, or if you need to step away, or you just want to write this down before you forget, the best way to follow up is this website here. Well, hold on, Jay. I'm already messing up. You've got to give us a better landing page, don't you?
Absolutely. Well, I don't know if it's better, but you can find out more at w2capitalist.com/bank.
I'm going to
4-letter
update that.
word that you've made me now appreciate. I'm going to drop it in the chat just in case people want to click on it and go ahead and use that while you're talking, right?
Love it. Yeah. Thank you very much. All right. And I think I've got it already updated. w2capitalist.com/bank.
That's it.
How we doing? Did I get it up there?
Let's see. Perfect.
All right. W2. And somebody said, hey, what's a W2? And so, I think that's a good question because honestly, if you don't know what it is, that means you're free. But if you do know what it is, you know that it's a great way to support your addiction to real estate, right? So how many people here, and I love the strategies that Jay brings on. How many people here, do we have a way to do a quick chat of anyone who'd like to? And you can send it directly to the panelists only, or you can share it with all attendees. Who here has a W-2 and who here is just doing real estate full-time or no W-2, meaning no day job, feel free to write that in the comments or chat here very quickly so I can know how many people are off of the W-2 and some people are. So it looks like some people are leaving the W-2 in 18 months. Thank you, Frank. Looks like, let's see, the box is too small. Jason says W-2, 1099, husband is W-2. Thank you. Okay, retired. Very good. Thank you, guys. I have a W-2 working for Uncle Sam. Well, Marcellus, I appreciate that. That's right on. W-2 and real estate income, hoping to get out in 12 months. Rock and roll. Let's see if we can find a way to help spin this financial flywheel to get you past escape velocity and break free from that W-2. That's what we'll help you do today. Love it, guys. Thank you. Thanks, Johnny. Okay, so first pop quiz, and there is a prize to the first person who answers this correctly. A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back the minute it begins to rain. Who said the quote? Who said it? J.P. Morgan, Mark Twain, Abraham Lincoln, or Will Rogers? Hey, all right, we're getting some answers. Anybody else? Guesses? First person to get it right. Anybody know who said the quote? We've got some smart ones here. Wow. All right. Final answers. Okay. Well, that was super fast. Probably the fastest I've ever seen. And everyone's getting it right. Mark Twain, Jason May. Jay, would you be willing to write Jason's name down somewhere? And
I will. Actually, I know Jason very well. He is a member of the mastermind. And so, yeah.
Well, there's your reason. The smart guys get it right. So very cool. I will send you a free copy of the best-selling book that Pamela Yellen wrote a few years ago called The Bank on Yourself Revolution. So that's coming your way, digital or in print, whatever you prefer, Jason. So as long as Jay has your email address, we'll connect and send that to you. So rock and roll. So again, a banker is a fellow who will lend you his umbrella when the sun is shining, wants it back as soon as it starts to rain. That is so true. I can't tell you. I've had too many people have their lines of credit slashed in the midst of the downturn. And certainly there's nothing like good times for banks to lend you money you don't need, and then to take it back as soon as you start to need it for an emergency. And I've noticed a real problem. If you guys look at the average surveys that come out pretty often, the Employee Benefit Research Institute says that 1 in 5 survey participants have a loan against their 401k. I also read in that same survey that 34% of people took money out of their retirement plans in their 50s, meaning they're getting penalized and taxed before retirement years. And more than 60% of Americans have less than $25,000 set aside for retirement. That means 6 in 10 of us on the averages. So we are a cash-strapped nation. In fact, the average family would have to sell something or go into debt just to come up with an expense of $400, like a set of new tires, and you're having to go into credit card debt for something like a set of a tire or two. So you guys, we don't need these statistics. We all know the truth. We all know the reality is we're a cash-strapped nation. We're in debt more than we've ever been. And I believe it has a long history here and a lot of roots beneath it. But it boils down to 3 basic kind of vortexes, kind of a spinning downward spiral, like you might imagine a tornado going downward or drain coming down. So it's debt, speculation, and lifestyle. Those 3 spin together to create this downward vortex that too many Americans are stuck in. I think it starts with honestly, it might start as low as the what's the old like the sin of envy, right? Envy of lifestyle, trying to keep up with the Joneses. So we go into further and further debt, and then we have to speculate to keep up with that rate of return that we need. And if you look at the average American's steady budget in 1940, the average American spent about 11 cents of his or her dollar to service debt. And somehow our grandparents were able to save 27% of their income back in 1940. According to the Department of Commerce Bureau. 27% saved? Now, these days, we're at 2020. We started the year before Corona hit. We were at 36% of our income to service debt, not to pay off the debt, just to service it. And then we were able to save close to 5.4%. Now, you guys might have heard that we had a major uptick of savings in the second half of 2020. But now if you've kind of seen the more recent stats, we've been trending down and saving less of our income as we prepare for the end of the government benefits and more. So it appears the money that we received, or some of us received through PPP loans or unemployment checks, whatever, back in the early part of the year, went right into our savings account. And since then, we've had to spend it down to cover bills and groceries and so forth. Jay, any thoughts so far?
Yeah. Frank asked a really good question, but why save at 0%, which is almost the interest rate you're going to earn on pretty much any bank bank savings account, checking account, anything like
Yeah.
that. It's almost at 0%. So it's a really, really good question.
Yeah, it kind of gets to the point. Frank, let me get rid of this for a second. Let's talk about the banking business model, because you guys know, and Frank, it's a great question. You guys know banks have been around since the beginning of human civilization. And there's an old book called Debt: The First 5,000 Years by David Graeber. Great book. I love the title. The best part is the title, I think. But it really reminds us why banks have the biggest building in town. If you think about it, Frank, let's say you're coming in with 10 grand to your local bank and you want to deposit that 10,000 bucks. Okay, great. That's fine. And you are given, as a reward for being such a diligent saver, you're being given 0%. All right. And there's a guy behind you. Let's say I'm behind you in line who wants to borrow 10,000 bucks. All right. So what did the bank do? The bank took your money, is giving you pennies for the privilege of holding your cash for you. And then they'll loan it to me as the guy behind you in line needing a loan. And what do? They charge me 10% or whatever they want, right? 5% even. Even if it's just 5% on my loan, you got 0% of that deal, didn't you? And yet the bank has an infinite return. You think about it. How much of their money did they have in that deal? They took your money. They have to keep a little bit on reserve for FDIC insurance, although it's currently the reserve requirements this year are 0%. 0%. And then they can loan it to me at whatever interest rate they choose, and they collect the fee. And you don't see a penny of that. That's why banks are so profitable. And that's why we're able to take the problem of banking and make it part of the solution. So, Frank, you're saying banks and churches laugh out loud, and now government. I'm not sure what you mean there. Jay, do you have any like context there, or any idea what he means there?
I do
Okay.
not.
The biggest buildings.
He
Yeah.
says.
In fact, Frank, I'll tell you a quick story on that. I went to school in Texas, and there's all these small little West Texas towns on my way from Dallas to Abilene, where I went to school. And along the way, there's all these little towns, and there's always three buildings: the bank, the church, and the bar. I didn't see a lot of government buildings. I guess Texas is that way. But I kind of imagine people would go to the bank to beg for money. They'd get denied the loan, so they'd go to church to pray. And then finally, they'd leave the church and head to the bar for, to drink your sorrows away. So essentially, that's sort of the process that banks have got us on. It's a hamster wheel. So let's keep rolling. But again, why would they have saved 27%? Well, partly it was they didn't keep it at the bank, and banks were offering a little higher interest than they are today, for sure. So trouble is, what happened? I feel like back in the 70s, and we won't get too far into the weeds here with history, but we started to move away from a savings culture with ERISA and some other tax laws that changed. And we moved more into the speculative environment. And this had a lot to do with boomers coming of age in the 80s and 90s. And we've had a 20-year run from 1980 to 2000, where the stock market was doing an average of 14% a year. I call this the Roaring 20. The Roaring 20. It was actually coined the phrase by a gentleman named Les Himmel. It's the 20 years from 1980 to 2000 when boomers were pumping money into this brand new thing called a 401k. 401ks were brand new as of 1981, along with other things like IRAs and more, 529 plans, 403b plans. All of these things on the screen here are speculative instruments. And boomers, the largest segment of our population, were entering the workforce and dumping money. In fact, they became incentivized to dump money into the stock market for the first time in our country's history. So we went from saving to speculating. Back to our kind of three-pronged problem here. Speculation became the nature. We all became professional investors in the late 80s, early 90s. And we saw the market boom. Average of 14%. That's pretty darn good. I'll take that. But since 2000, we've had a dramatic lowering of the market's returns. Average returns since the year 2000, closer to 3.6%. I'll say that again. The average real return of actual investors, according to third-party research, including Dalbar, who does an annual report on investor behavior, the actual return over the last 20 years has been about 3.6% before taxes. Yikes. So would you be willing to accept the risk of the market for that kind of measly return? And now boomers are about to start retiring, and many have started to. In fact, the statistics are for the next 20 years, So I'll call the first 20 years the roaring 20. I'll call the second 20 years from the year 2000 to now the boring 20. Okay, because boring returns at 3.6%, that's pretty boring to me. The next 20 years, if anyone wants to ask me what's the next 20 years of the market, well, boomers are going to retire at 10,000 people a day. We'll call it the Jay. Do you want to? I'll keep them in suspense. What do you want to? What would you like to say?
The boomer 20.
Yep. I'm trying to keep a rhyme going here. So, the flooring 20. I like that, Marcellus. Very cool. Yeah, I was gonna say the flooring, like we're hitting the floor. I like it. So we got the roaring 20, the pouring or the boring 20, and then finally I'm calling it the pouring 20, POOR, because the market's who's gonna buy all that stock as boomers are selling for groceries and to keep up with their living and so forth in retirement. If the largest lump of our economy and most millennials aren't ready to pick up the dropped sold stock or mutual funds because they all grew up and came of age in 2008. But I'm getting ahead of myself. The main thing I'd like to mention here is most clients I meet with say, hey, Mark, I can't save that much. I can't be my grandma and grandpa. I can't save 27% and get 0% return at my local bank. So I'm going to have to risk more. I've got kids to put braces on their teeth and send them to soccer practice. I've got my parents who are aging. I've got all these other expenses coming up: 3 car payments, 2 mortgages, some old student loans to take care of. I can't save 27% of my income, so I'm going to save more like 4 or 5%, and I'll take that 4 or 5%. I'm going to put it into riskier and riskier investments, and hope and pray that my rate of return will be higher. So that's where I see most people's kind of philosophy going. Now, most people on this call get it. You guys get it. One of the ways to bypass that trouble of the market and of kind of future volatility is to keep calm and invest in real estate. So, I won't spend too much time here, but we have to realize that there are some hurdles to success in real estate. Growth is just 1% a year above inflation. There's some times when we don't have paying tenants. 2020, anybody? There's a lot of ongoing expenses, property taxes, that old heater finally breaking last summer, all those things, and AC unit that broke last summer, all those things that cost money to keep and maintain these properties. And besides that, really, if you think about it, we're not truly in control of our equity. Even though it might be on our spreadsheet, hey, I've got 100 grand of equity in this property down the street. The truth is, I really don't have access to that money in the drywall. A bank has to be generous enough to give it to me. And Zillow has to be generous enough to say my house is worth or my rental property is worth enough to give me that equity in the first place. And there's no guarantee that Zillow is going to be kind to me tomorrow. So, if I think about it, if I really think about it, when am I most likely going to need access to capital? Well, during a crisis. And when are banks least likely going to give it to us? During a crisis. And when am I least likely going to be able to sell my property at a fair price? During a crisis. So real estate's awesome. It's as old as the pyramids. I think it's an important part of our financial portfolio, but we have to think about the asset and the liability nature of all real estate. So obviously we can do all sorts of strategies for our real estate needs, but I like to start first with, what do I want my money to do for me? Before I get into all of this, I see Todd has asked a question here. It's about control over the investment. REI is great for that. How can I fire my banker? Todd, you're in the right room, man. That's exactly where we're headed here in the next 5 minutes. We're going to get into some examples, and for the next half hour, we'll go over some numbers, answer questions. So bankers are, I think, the problem. Banking is the solution. Let me say that again. Bankers are the problem. Banking is the solution. So banking is a verb. Verbs are they just exist. Nouns can be changed. You can put somebody new in the banker's desk, behind the banker's desk. So I'd say the first thing we do is we fire our banker and decide for ourselves to bring in-house the banking function in our life. Whether we realize it or not, we're already in the banking business. Either we've given another guy or gal the job of the banking function in our life and in our real estate needs, or we've decided intentionally, like Jay did, to become your own banker and to fire your banker. So Todd, great question, man. Before I get into specific strategies, I always like to start high level and just start with the question, what do I want my money to do for me? That's an important question, I feel, because where you keep your money makes it do different things. A savings account is different than a hedge fund. And what do you want your money to do for you? That's a different answer for each person on our webinar today. Think about it for a minute. In fact, take some time, and those in the chat, jot it down. Send me your comments. What do you guys want your money to do for you? Peter says, buy Bitcoin. I want to ask to go one layer deeper, Peter. That's a great answer. But what's important about that for you? What characteristic do you want your money to have? What attributes do you want it to have? Okay, John says work for you. Awesome, that's great. So that I'm going to assume that means grow for you. I think Marcellus, and maybe if I'm wrong, John, just chime in, give me some clarity on what work means for you. Marcellus writes, I want my money to bless others and give time back. Oh, that's great. Love it. Chad writes, to work for you, produce cash flow and returns. I love that. Great. Yeah, you want it to work. You want it to produce. You want to have it work for you rather than the other way around. Produce some sort of cash flow, paychecks. Love it. So what are some other characteristics, guys? Grow passively. Jason, thank you, Jason. Grow passively. Again, I'm hearing a lot of similar concepts here. I want some sort of steady, consistent, passive, don't have to think about it, don't have to work for it kind of cash. That's great. Leverage. That's another really good one. Thank you, John. Leverage meaning creating the most amount of wealth for the least amount of money invested. That's great. One or two more just for fun. This is great. Hopefully this is helpful for you guys too. Most people live free in retirement, Chad writes. Cool. Cool. And only you know what live free means or what that looks like. But I love that. Give some continued thought to what freedom means. What does that look like? Are you on a beach somewhere? Are you with your grandkids? Are you, volunteering at the local charity? All those things. Awesome. Tokenize assets. Peter, I'd love to hear more, man. This is great stuff. So I'm gonna think about these things as we move forward through our conversations. But again, where you keep your money makes it act different. And if your money is in the wrong place, that's a problem. Most people live their whole life and don't ever sit down to say, hey, what sort of characteristics do I want my money to have? And shouldn't I put my money where it will act the way I want it to act? So a fish in the wrong environment is dead. Fish out of water, not going to live too long. But you put a fish in the right temperature controlled, well-fed aquarium, you're going to have lots of little baby fishies floating around, enjoying life, chilling out together. And that's really what we're talking about here. Most financial environments take away your control. That'd be Wall Street. Think about that. Who's in control when you've got your money in Wall Street or in a 401k or IRA? When the government tells you you can't touch your money without getting a bail bond slapped on your money until you're a certain random age, who's in control of that? Not me, not you. Banks, credit cards, finance companies, real estate inventory, etc. A shoebox, sweet. All sorts of things that bring and or take away our control. Again, I like to say, let's start with the function of money before we get into labels. But if you could design your own perfect financial instrument to do what you want for your real estate investing, the characteristics matter. So this was my little list as I was thinking about this for me and my family and my life for real estate investing, but ultimately for my own financial freedom. Now, you feel free to jot these down if this helps you think through this thought exercise. But to me, it's easy access to cash. I want some sort of liquid access to money, both for opportunities and for emergencies. I want safety, something that's some sort of financial institution that's not just running this by night. I don't want my uncle, my long distant uncle, taking all my cash and just, going on his word that he's going to keep it safe. I want third parties auditing financial institutions where my money lives. I want it guaranteed on my principal. I want to make sure that money's there tomorrow when I go to look for it. And I want some sort of predictable schedule of growth as well. So I want guarantees on my principal. What's the old Will Rogers quote? I'd rather a return of my money than a return on my money. But I do want to return on my money too. Don't forget, I need to keep up with inflation. I need to beat inflation. I want some sort of tax advantages. I don't want to get dinged on my tax return every year. You think about it, a certificate of deposit, or as I like to call it, a certificate of disappointment at the bank, pays you 1% a year, and then they go ahead and tax you on that 1%. I mean, come on, it's like getting slapped at the end of a really bad date. So I don't like CDs for those reasons. They tax you every single year. Jay, I don't know if you know anything about getting slapped at the end of a date, but that's one of my big problems with CDs.
Not in a long time. Thankfully,
Good.
my wife and I get along very well.
Good man. Good man. Well, we're celebrating 16 years and my face is still red, but I'm going to take it. So,
That's awesome.
so that's my short list. Tax-free access to money. Why not? Let's get the money out income tax-free. I believe, and most economists, I think, agree that taxes are going to go up over the long term. I'm not talking about next president administration. I'm talking about 10 years, 20 years, 30 years, 50 years into the future. What are tax rates likely to do in this country and beyond? They're likely going to go up. So I want my money out of that cesspool and into something that I can access without any taxes due. I also don't want controls on what I can put into this thing. I want to be able to access and dump any amount of money I want into this, and I want it to be treated like a Roth IRA whenever I take the money out. I want flexibility. I don't want to have a bunch of prohibited transactions. If I want to fix up my rental property down the street, or if I want to fix up my kitchen, that should be my business, not the business of any other outside institution or government telling me I can't touch the money for my kids' college or the minivan or whatever I want to do with my cash and my finishing out my basement and whatnot. Tax-free legacy. I want to be able to leave this to my children and grandchildren and charities without any kind of issues with being dinged by the Internal Revenue Service. All right, pop quiz, guys. First person to get this gets a prize. What do you get when you put the words "the" and "IRS" together? Write it into the chat. All right, Frank, right on. Theirs. That's right. Theirs.
That was quick. I think Frank's heard that one.
All right.
That
cool.
was good.
Right. Do you mind writing Frank's name down, Mr. J? And right
Not
on.
a problem.
Cool. Awesome. So what if you could see your money grow at a faster rate every single month, every single day? What if your net worth on a predictable schedule was larger today than it was yesterday? That'd be pretty cool. What if you could keep your money liquid and accessible as an asset on the balance sheet for your business? What if you had a plan, not just for this year's real estate needs, but every single year, the next year, the next year, the next year? If you really stop and think about it, when do you ever not need money? And banks get this. They're in it for the long term. They're already thinking about how they're going to get money out of your grandchild's pocket. That's how big and long these business plans are from a lot of these mega banks. Heck, the credit unions too. And you own, what if you could own and control the outcome of your financial strategy before you even started? Think about that. When you buy that real estate property, what if you could own and control the outcome of what would happen to that real estate property before you even bought into the deal? That is control. That is assurance. As far as anything is assurance on this side of heaven, that's pretty awesome. So let's get into how we can make that possible, because there is a financial environment that's able to do all of that. And funny enough, in the whole of the financial universe, I was unable to find anything besides a dividend paying whole life insurance contract of all things that met all of those requirements. These old fashioned whole life policies have been around for several centuries now in this country. And yet they meet all of the characteristics I just listed for you guys on the previous couple of slides. Funny as it might be. This is a strange world where a certified financial planner is suggesting that we even talk about cash value life insurance. The more I studied this tool, the more I couldn't turn away from what it was able to do for me, these unique and mostly forgotten financial attributes that's been around for centuries, over 200 years. So, minds open, hearts open for 5 minutes at least. Let me show you why I think it's a compelling tool in the tool belt. So first of all, it's not the kind of whole life insurance that Dave Ramsey and Susie Orman love to hate on. This is a categorically different type of tool. Oftentimes the old fashioned life insurance is what they're describing. And I've not seen that in the wild, issued anyway in the last 30, 40 years in my 10 years of business. These policies are more cash heavy, meaning we take a big pay cut to design the policies with this in mind, 50 to 70%. And more of the contributions to the policy are going into a special rider that gives you incredible, massive cash value in the first month, in the first year, and the first several early years. And it allows for compounding and the use of the cash value from year one, month one as a financial management tool. So whole life insurance, it's been around, like I said, for many years, and it's always grown. It's guaranteed to grow. And that's a very unique and very important word in the financial universe. You can't just throw the word guarantee around and call yourself a financial professional. But the contract itself includes the words guaranteed cash value accumulation. So every year they give you a literal schedule. Here's how much your cash value will be in 1 year, 2 years, 5 years, 20 years, and every point along the way. So I know with a minimum guaranteed assumption exactly what my net worth will be this year, next year, the next year, and every point up to my retirement and beyond. And the growth of these policies are nothing fancy. We're not going to be, hitting it out of the park every year with returns, but they do grow better than other cash equivalents in my portfolio, certainly better than bank accounts, certainly better than money market accounts or even bond funds. But the money, unlike a bond fund, unlike a CD, the money is accessible for any reason. I can use it for inventory, for my business needs. I can use it for my personal life, my kids' college, whatever I choose to use it for. And of course, since it's life insurance, I'm going to instantly create a legacy, income tax free to my heirs or my favorite charity. That's an obvious statement as it's life insurance. Nothing else I'm aware of lets you do that. Unless, Jay, you're a famous painter, and I'm just not aware of that. The only other way you can get rich when you die is if you're a famous painter. So right on.
I did some painting when I was younger. They're not going to make anybody any money.
Yeah. Yep. Right on. Yeah. I think they'd even, I think even my wall paint, my drywall painting, I think got torn down. So, I'm even terrible at doing a flat paint, flat matte paint. So, and then guys, the big one for me is become your own source of financing. So if we could be talking about any other tool in the financial universe besides life insurance, I'd be talking about that. Believe me. Anything else out there has got to be sexier to talk about than life insurance policies. But the only thing I'm aware of that lets you have a line of credit to yourself where you can set up your own source of financing like a bank. We're not literally setting up an FDIC insured bank here, but using a cash value life insurance policy, using the function of that policy like a bank is a way to overcome the problems of paying cash and using a normal bank function down the street. So let's talk about how we can do that. So modernizing it with these special riders allow us to build wealth right away. We're using a mutual life insurance company. Mutual is different than public. So there's two kinds of life insurance policies out there, and there's two kinds of insurance companies. The company variants are public traded. That'd be a MetLife, for example, publicly traded on Wall Street, whatever. And then a mutual life insurance company is owned by none other than the policyholders themselves. So that's important to keep in mind. Once you've earned money in one of these contracts, the gains are locked in and predictable, meaning I can't lose the earnings I made last year in my policy. This is different than, say, Tesla or Coca-Cola stock, where I can earn some money this year. The value of my stock could go up. I could even reinvest dividends, and then I could lose those dividends next year, couldn't I? If the market takes them from me, and then that's money gone forever. When I borrow from my policy, it will continue to grow for me as if I never touched a dime of the money. And let me just hold on right there, because oftentimes that can bring up some incredible questions or just at least funny looks whenever I say those words. So I'm going to say it again. If I've got $100,000 in cash value in this life insurance policy, that cash value word, for those new to this, cash value is the money I can tap and use while I'm on this side of the grass. Okay. The death benefit is what I can use and give to my family, or Frank, as you say, your favorite charity, on the other side of the grass. Once I've passed away, my family or whatever gets the death benefit. But while I'm still breathing, I can spend all the cash value. I can either make a withdrawal on that cash or I can borrow against it. So back to my number, if I've got $100,000 of cash value, and let's say I take $30,000 out to go buy a car, that year, my policy will give me the full growth and the dividends as if I had not touched any money on the entire 100,000 bucks. And I've got the car. So tell me, doesn't that give my car better gas mileage? Doesn't that give my financial life better gas mileage? When I've got the car and my policy, I'm letting my money do two things at once there. So that's a powerful tool by overcoming the problem that we'll get into in a minute called opportunity cost. So we do control the cash in this policy. There's no RMDs on this, no required minimum distributions. There's no prohibited transactions. I can use this for my kitchen or my real estate deals. I can use it to pay off an old credit card debt. I personally use this for my student loans to wipe those out early on. Marcellus, he has a great question. Jay, do you want to read that one for our listening audience?
Yeah. Marcellus says, will that reset to the $30,000 dividend value, which I think he's talking about cash value the following year, right? So what happens? You've got the $100,000 cash value, you take 30,000 out. What happens next? Will it reset at the end of the year or that sort of thing?
Great question. And I'm going to show the numbers for our visual audience here as soon as I get to the slide here in a couple slides. But to answer your question, no, the dividend will stay the same, whether it took you 5 years to pay off this loan or 15 or whatever year you choose. Again, I haven't said it yet, but you are in control of the repayment schedule of this policy loan. So if I've got 100 grand of cash value, I borrow out 30 for my car, I'm going to get growth on the entire 100,000 bucks as if there was no loan this year, the next year, the next year, the next year, until I pay off the loan. And Marcellus, if I never pay off the loan, it's simply deducted from my death benefit when I pass away. So that's how they get theirs. You know, the insurance company, they know they're getting paid back because I'm not made of metal. I'm going to, push up some daisies at some point. So that's how they get paid back. Does that make sense? Right on. Okay, so I'm going to keep moving here, guys. But again, if you have any kind of health issue or age, too many birthday candles on the cake, so to speak, don't count yourself out. This is still a tool that I have set up for folks. I'm in the middle of helping a gentleman in his late 80s, Jay, get a policy.
Wow.
Yeah. Wow. What a beast.
That's incredible. Can I mention here though that there are, so I just turned 41
87. Oh, I'm sorry.
No, yeah, okay. Thank you. I feel like an 87-year-old, but no.
So do I.
there is some things like when you hit 40, that's like a big number to the insurance agency. And luckily I passed with a, flying bill of health. And so, I was approached with this when I was in my 30s, also when I was in my 20s. And I actually had a smaller policy. I don't think it was the same. I eventually cashed it in because I started listening to Ramsey and that stuff. But I had a policy when I was in my 20s, very low premium, very high death benefit because I was 20 years old, right? And again, when I started looking at my 30s, I went down this road. I started looking at some stuff. I was like, yeah, that just seems way too good to be true. The point I'm trying to make here is that, and I'll land this plane and turn it back over to you, is that the earlier you are in age, a lot better premium you're going to get versus the death benefit. So don't wait around till you're 40 and you're like, oh, what do I do? Hopefully, stress over passing the physical exam. Take some action now. That's just my encouragement.
Amen. Well, that plus just the basic concept of time value of money, right? Given that, we all could have had mom and dad start one of these when the doctor slapped her butt. I mean, that'd be a great way to get started in life. But given that we can't go back in time, I will tell you this, average Joe who's starting this at 67 versus 27, the way we construct these policies is not so much about the death benefit as it is about the cash. So whether you're putting in this, whether you're 27 or 67 or another number, we just adjust down the death benefit. We squeeze that death benefit as hard as we can. That's where the commissions and the expenses are. Got to have some of it there to make it life insurance so it grows with income tax advantages and more. But we squeeze that death benefit down super hard, squeeze out all the excess, and pour most of your money into the cash value. So whether you're 67 or 27, you're going to have a similar cash value at the end of the first year, second year, and so on. But again, I will mention I've got folks who had a guy who had a open heart surgery. He's just straight up uninsurable when you have that. So he's loving the concept, wants to be a family bank for his family. So he's grandpa. So he bought a policy on his wife, which is got to be some good jokes on that, insurance on your wife, and then mother-in-law and all that. And then the adult children, he got some policies on them, and then all the grandkids. And he sits them all down a couple times, and does about once a year. And he'll tell them, hey, here's what we've got in all of our policies. Here's what we're going to use them for. Here's the real estate we're going to buy as a family this year. He's the owner of all the cash in those policies. He's the beneficiary, God forbid, if his wife passes before he does. But when he passes away, he's going to give all these policies to their respective family members. And it becomes a multi-generational, enterprise at that point, not unlike the Rockefellers.
Yeah, and that's where I'm personally headed, right? Now, we were talking yesterday. I've got a spot on my calendar I'm pointing to over there where I'm going to talk about, all right, let's figure out what we can do for the kids to get them set
Rock
up.
and roll.
So
it's awesome. Yeah, that's thinking long range. There's if you want to be poor, think about Saturday nights. If you want to be rich, think 3 generations. That's the key. That's really the key to this whole talk today, guys. Let me show you an example of a real life friend and colleague of the Bank on Yourself community, as we call it, Bank on Yourself. These whole life policies, I'll refer to them as Bank on Yourself type policies as we go here today. But Dan Proskauer is an engineer out on the East Coast, and he was willing and kind enough to share with me a visual of his net worth. So from the year 2000 to 2009, he tracked his net worth, and you can see it very clearly on the screen here. It bounced up with the tech bubble. It bounced up again with the housing market run up in 2006, 7, and 8, and they crashed correspondingly the years after those bubbles popped. And as you can see, back to the boring 20, as I mentioned earlier, he's had basically a full decade there in the first half of the millennium, the first 10 years there, of basically nominal or no gains in the market. So he's been one of the recipients of the boring 20. But in 2009, he was smart enough to open up his first Bank on Yourself type policy. He's since opened up many more policies, and watch his net worth truly grow. Watch that thing grow. That's true, real wealth locked in. Everything else is paper gains, paper losses. You feel rich one quarterly statement. You feel poor the next time the 401k sends you that quarterly statement. But these policies are true wealth being locked in each and every year. He's tripled his net worth in nearly 10 years. Not so boring for him these last 10 years have been. Little Yoda there for you. So again, let me kind of move on here. This is not a good fit for everybody. I want to be very clear. This is a nuanced, custom designed solution for each person. And, partly what we've been able to do, Jay and I have set up a simple web page where you guys can fill out some info. And again, that web page is w2capitalist.com/bank.
Bank. Yeah.
Did I get that?
I got to talk to you about this link that I see at the bottom of your slide here. That should be w2capitalist.com/bank every time.
No. Every time. Here's what I'm going to do. I'm going to put it up on w2capitalist.com/bank. There we go.
Yep.
And if anybody goes to that site, that one, the wrong one at the bottom of my page there, make sure to write Jay's name at the bottom. And that way we'll make sure we know how we know each other. But yeah, this is the website, w2capitalist.com/bank. You'll see this when you go to the right website.
Well, and the reason why that's, and I did not say this at the beginning, and I should have, when Mark came on the podcast and made the light bulb go off for me, I was like, you know what? I'm looking for sponsors of the podcast. I only recommend and promote things that I use, like Deal Check and now PropStream. And you, right? And I was like, let me see if Mark wants to sponsor the podcast. So after we, got I wanted to go through the whole process first and say, okay, Mark did a good job. I like what's happening. I like the flow. I want to present this to the audience. So then we entered into this sponsorship, right? So he is now a W2 Capitalist podcast sponsor. So that's why the emphasis on the link can be messing with you a little bit there about the link.
That's great. Yeah, love it.
Either way, w2capitalist.com/bank or Mark's link here. Get on his schedule. There's one thing that I've talked to several people who, and maybe I just adopted this from them, but I talked to several people who they're not client of yours. Unfortunately, they talk about how, well, anyway, I'm not going to go there. But I knew they did this concept, right? And I was like, all right, so tell me about it. And almost every one of them said, my only regret is I wish I would have started sooner.
Yeah.
And now that the light bulb's going off, I was like, yeah, I'm in that boat. Let's row together. I wish I would have started sooner. Again, just want to pressure you guys a little bit to take action, get on Mark's calendar, have a conversation with him, and just see what's available for you.
Man, you're so right. I know it sounds cliche, but you're exactly right. I was saying the same thing to someone yesterday. I talked myself out of my first two policies going from a large number to a much smaller number originally because I got scared. But the bottom line is you can start multiple, and I wish I'd started with the larger number. I would have figured out a way to make it work, but that's for another call.
That's another topic.
You bet, man.
Jeremy asked a really good question. What if you were previously denied insurance? And I'm assuming, Jeremy, you're talking about life insurance.
Yeah. Great. So, and there was another one about pre-existing conditions as well. So I'll answer that live. So I think my quick answer is, again, you might or might not have the ability to be the insured. Let me go back to this here. You don't have to be the insured to own one of these policies. And we'd have to talk about all the specifics, of course, Jeremy, but the key here is learn that you don't, it's just like in real estate, control versus own. And there's a value to having both of those in your financial portfolio. If you control and own these policies, anybody who you have an interest with can be the insured, your spouse, your LLC partner, your children, other people that you've got in your life that are important enough to have a financial impact in your life. All of those people. I've got a policy, shouldn't say this, but on my mother-in-law. So more jokes to come, I'm sure. But
wow, I didn't know that. That's interesting.
Oh yeah. She never comes over anymore. It's great. No, I'm just kidding. I love her dearly, actually. So, but I'm joking about that. But we set that up for very important reasons. We know someday we love her. We talk to her every day on FaceTime and see her many times a year. And someday she might need some, she will ultimately pass like all of us, and it's going to be a great gift to us. And she didn't have to put a penny into it to create her own inheritance for us. Talk about a way to change the family tree. She didn't have to put any money into that deal, and she's going to change the lives of her kids, her grandkids, just because she said yes to setting up a policy. And we control the cash. It's our cash. So that's just one way you can use this for your family's advantage. All right, I better keep moving. Let's see. We do have some other important questions.
We got some other questions. You want to run through them real quick?
Yeah, sure. Roll through them with me.
Marcellus, he asked, does this still make sense for more smaller spending? And what about for general regular payments, bills, etc.?
Yeah. Okay. I will say, don't do this if this is not your case, Marcellus, I assume, but for folks that don't have ability to save, I would say just pay cash for things that are like your smartphone and your utility bills and that sort of thing. There are some strategies that will encourage you to run your entire financial life through one of these policies. And while that can work, I've seen it. We have clients that are doing it. I call it the black belt strategy because it can be very, you've got to be like a ninja with your budget when you do this with your entire cash flow. So that's a quick answer to your question.
And what in real numbers, what are we talking about just for an annual premium? Are we talking, what's a minimum that you would say, hey, if you can't cover your, general living expenses plus this annual premium, then you probably need to get on to some budgeting things and kind of get towards savings before you dive into something like this. What's a good number?
Yeah, like I say, if you can't rub two pennies together, that's usually a good sign. We need to focus on more primary things first. And Dave Ramsey is great for helping you get on your budget and all that. My minimum amount I've seen clients really work well is just a couple $100 a month. Yeah. $300, $400, or $500, something like that each month. That's the minimum.
You said a couple of dirty words there. I think Ramsey is good. He helped me get my train back on the track, but after
Yeah.
baby step 2 and 3, I was like,
Yep.
this is not going to build the wealth I want to do.
Are your kids
My
still
and
doing baby steps? No, I hope not, right? I
no,
hope your kids are on
well,
to running and jumping and skipping. Some of them might be young enough to,
number 3 is
yeah,
getting their balance.
good, good.
But
It's supposed to be a temporary thing, right? I don't want to live my whole life walking baby steps,
yeah, yeah,
you know?
exactly, exactly. That's a good point. Hannah asked, she's going to schedule time talk for sure. 27 is a good time to start, right? LOL. Hannah, I started, and this kind of covers you and Marcellus.
Marcellus.
Sorry. Marcellus is in the mastermind. Maricela is also in the mastermind. I combined the two. Sorry, Marcellus. But you guys, when I started with this other policy when I was in 20, I was 21 years old and I was doing $100 a month. And I didn't know what I had at the time, but thankfully Mark came along, and now I'm like, I got to catch up. Marcellus asked one more question. What about if you have SGLI for us government folks?
Yeah. Okay. Yep. So SGLI, great. Thank you very much for the contribution and service you have to our country. You're making this webinar possible. You're making everything we have in this country possible. So thank you. SGLI, great company or great service for life insurance for government workers, military, and more. It's not a company I would recommend for bank on yourself type policies, which we are going to get into in the coming pages here. So are we good to move on, Jay, for now?
Let's move on. I'm going to get
right.
clarity on one more question, but let's move on for now.
Just pull me over when you're ready. So
Okay.
why are these policies strikingly better than just traditional ways to buy things? It's something I call opportunity cost. Really, it's a common phrase in the financial world, but let's talk about what it is. So imagine this arrow across the screen is time, and the line is also representing a net worth statement. So most people everybody born starts at zero, and none of us have a hearse with a U-Haul behind it. So we're all going to start and stop on this line. But let's talk about what happens if we don't have money saved for a car. We need to buy a car today. We go into the car dealer. We have nothing in our bank account. How are we getting a car today? Well, we're going to go into debt to buy that car. So now we see the line below net zero. And what happens 30 days after you take a loan? Something arrives in your mail called a bill. And on a regular basis, we're climbing and crawling and scratching our way back to the top of this line to scream, call up Dave Ramsey and scream, I'm debt free. But of course, we now have a 5-year-old car and the kids are kicking the back seat. And so we're needing now to go into debt again, get that new car, get the nice smell back, whatever it is. And so we're constantly on that treadmill to climb and scratch our way back up to zero. And I don't want to live my life just crawling my way to the starting line of my financial future. So most people think they can beat the automobile financing and loan rackets by saving up in a savings account or somewhere like it. Save, drive the old car for a few extra years, hope and pray it doesn't fall apart. And then we've got our money in our savings account and we feel such an adult. And then what do? We withdraw that money out of our savings account and we pay cash for the car. And what happened? How much interest are we now earning on our money once we spend it? Zero. We've broken compound interest. And that's the most powerful force in your financial life. It's the most powerful force in the universe. According to Einstein, uninterrupted compound growth, greatest wonder of the world. And we have to start saving our money again slowly for the next car. And so if you notice, this is a mirror image. Savers and debtors have the same problem. They're both tied down to the horizon line. We keep falling or climbing our way back up to zero. And that's not a great way to get ahead in life. The only way I'm aware that helps you break free and get that escape velocity in your financial portfolio is to overcome opportunity cost through one of these policies. When you borrow against a policy and pay yourself back, it continues to grow compound as if you never touched the money. Even on the capital you borrow, you're getting that same guaranteed cash accumulation and dividend. This changes everything. in your financial future. It's the small hinge that swings the big door in your financial life. So guys, I always tell folks it's not either or. It's not either we put money into real estate or we get one of these policies. It's both and. When you use the policy, you can use that cash for real estate. And we're going to show you how on the next couple of slides, 3 different strategies. Jay.
Dude, that picture is cracking me up. The guy looks like he's dancing. Sorry.
Yeah.
There's a couple of questions here. We'll just make sure we get them as we're going through here. Chad asked, his parents are in their late 60s with pre-existing conditions, but can they take out policies on their grandchildren and leverage the grandchildren's young bill of health?
Yes. Short answer, yes. There's oftentimes there's some details to be worked out there, Chad, but definitely chat with a professional, which I know you know Amanda. So definitely chat with her about what your game plan would look like, and they can make it happen.
Yep. And then John asked, what companies are you buying these policies from?
Yeah. Again, you want to make sure these are companies that are reputable. Back to my little list of perfect instrument here. You want to make sure they're third-party rated and 100+ year history of never missing a dividend. These need also to be mutually owned insurance companies. And talk with me offline. I'm not, a billboard for these companies, so I won't name a ton of them right now unless we really need to. But I will happily share a number of companies with folks as we need to. You also want to make sure these companies have non-direct recognition loans, which is back to this screen. That's what that is right there. It's a non-direct recognition loan. The only way they won't recognize whether you access the money through a loan or not is that particular feature. So, like nitro and glycerin, you need to make sure that your whole financial portfolio is working in conjunction, not fighting itself, but working in conjunction. Like peanut butter and jelly, like Jay and Mark, like Thelma and Louise, Mario and Luigi. We can keep going.
That's pretty good. Hey, one more question is back on the health thing, and I missed this one because they dropped in the Q&A session section. So thank you for your patience on allowing me to finally get to this. If you have a pre-existing condition, let's just say it's like meningitis or whatever the case is, will this seriously hinder one's ability to get a policy and employ this strategy?
Well, again, if you're the insured, it comes down to the details. And I'm not a doctor, so I wouldn't be able to answer all of those details, but we'd find out. Only way to find out is a free application for the life insurance company and see what they say. The underwriters will look at your details for free, privately, with confidentiality, and tell us. But even if you can't be the insured, you can still own and control the cash by owning the policy.
Yeah. And then one more just popped in. Does this mean you can draw from your benefit even if you don't have a job or income, as long as you pay the premiums?
Wow. Even if you're not paying the premiums, i.e. retirement, right? If I've got, $500,000 in my policy, and we're going to get to this next. If I've got $500,000 of cash in my policy, let's say I got laid off from my W-2. What bank is going to give me a loan? I'll tell a quick story. I had a lady and her husband, they got a divorce, and she used some of the divorce proceeds to pay off her house. He had begged her, "Hey, don't pay off that house. Don't pay it off." She did. She took the divorce proceeds, paid off the house, and what? She got disabled, and she lost her job, and the home value dropped. So now she's underwater. So now the house is upside. It's lost value. She's lost value. She paid off the house. She's disabled. She needs cash because she doesn't have a job. What bank would be willing to give you money if you're disabled, can't work, and don't have a job? So that's the problem with, traditional banks. Again, back to Mark Twain's quote. So let's talk about what this might look like here in 4 easy steps. 1, pack money into your policy. The more you pack in, the better you'll be in terms of using this as an asset tool. We said earlier, you could start it with a couple $100 a month, and that's true. However, the more you pack in, the more you can use this. So you put a couple $100 a month into the policy, that might or might not solve your real estate problems if you need big buckets of money for real estate deals, but it gets you on the right path. So let's show what this looks like. You put money into the policy grows even when you use the capital for real estate needs. You control the repayment schedule to the policy you own, And as you repay that loan, you simply recycle the money back through the policy, use it again for your next real estate deal, and the next, and the next, and the next. A couple of examples. Greg and Christy have used this to avoid getting any more entangled with their banks. A guy named Nelson Nash, who's just up the street, or was just up the street before he graduated on us from Jay, not too far, says when you control the environment where your money lives, you win. When banks control it, banks are going to win. You guys can use this policy for big stuff or small stuff, property taxes, homeowners insurance, HOA specials, repairs, maintenance, and even the down payment, or even, as I'm about to show you, a way to actually pay cash for the deal, the entire deal. So the first strategy out of 3 I'm going to show you guys quickly is the cash purchase strategy. Now, pay less attention to the particular numbers and more to the concept. As I like to tell folks, if you understand the concept, the details don't matter. If you don't understand the concept, the details don't matter. So follow the concept as we go through this. But the key here is when we borrow from the policy, we'll pay cash at closing for that property down the street. We'll continue to increase our market or increase our yield in the overall deal without any additional market risk by using the policy rather than just paying cash for real estate deals. And we'll develop a permanent line of credit for our real estate business. Let's see what that looks like. Yep. Okay. So this is a gentleman who's 45 years young, and he's putting away $32,000 a year into his policy. Can you guys see that on your side? I'm going to see if I can pull up my little laser light here. All right, cool. So right there, $32,000 a year. Keep an eye on the dividend. I want to keep an eye on those dividends. So in years 11 through 15, his dividends were like 9 grand, 10 grand, 11 grand, almost 12 in those years. Just kind of keep those in the back of your mind. Also keep in mind his cash value at year 15. So first of all, why would anybody in the right mind pay $32,000 a year for 10 years into a policy? You know, he certainly wasn't listening to any particular guru's radio shows if he was doing something like this. But for his trouble, he in 10 years has almost 400 grand. And by year 15, and here's the number to remember, he's got $515,000 of cash and a $1.2 million death benefit. Lovely. So in year 11, the same gentleman decides to take a loan against his policy within his rights, and he's taking out of the 400 grand of cash value he had the year before, right there, he's going to take a loan for $350,000. And notice those dividends. They're exactly like they would have been had he never taken the loan out. Powerful. That is the non-direct recognition advantage right there. Now let's see the same guy. Again, same premium. He stops paying premium after the 10th year, by the way. And now he's going to pay back his loan over a 5-year period. He pays back the loan, and his cash value is identical to what it would have been had he never taken the loan out at the beginning. So this is a way for your money to do 2 things at once. So let's lay it out side by side. You know, whether we pay cash or use a policy, here's the results. If he simply paid cash for the real estate, let's say the real estate deal at 350 grand grew at just 3% a year. That means after 5 years, he'd have $405,000 of extra equity paying off that house. I'm not recommending you pay cash for a house like this, by the way. I'm just showing this as an example. But after 5 years, your $350,000 house would grow to 405 grand, equaling a total return of $55,000. Now, if you were to use the policy to buy that same house is still going to grow as if you just paid cash for it. The house doesn't care how you bought it. It's just going to grow. So we still get that $55,000 of growth to 405. There was some loan interest. Anytime you borrow from these policies, there is a loan with interest applied. We can get into why that is, but the APR was 2.1%. 2.1%, pretty cheap for money. And the policy on its own, without him adding any more premium, grew by itself from year 11 to 15 by $119,000. Wow, by itself. So the overall ROI was 10%. And his total growth was $175,000, not 55. Jay, easy
No.
question. Which of these two would you rather have?
Oh, the one on the right, far right.
Right on.
I'll
Right
take
on.
the 175 any day of the week.
Yep.
Any day of the
Yep.
week.
Right on.
I have a question that came in from Todd, also a mastermind member. A lot of mastermind members here today. It says when banks look at your cash, right, in your bank for mortgages, will they consider these funds as quote unquote cash?
Oh, smart question. Yes. If you need to use a bank for your convenience rather than them using you for their convenience, then please do use this, use that, get that. So use this policy as an asset on your balance sheet. You become much more borrowable, much more attractive. And in fact, think of it. The bank knows they're going to be paid back whether you live or decide to get on to bigger and better things before that loan is paid off to the bank. They'll collateralize that policy's death benefit if you need to, or they'll just see you've got a nice, solid current asset in the cash value. That's a strong current asset on your balance sheet. I actually called or had an interview with a commercial lender here in Chicagoland, and he was able to just sort of talk through why whole life insurance is a strong asset for borrowing purposes and looking more borrowable if you need to use this for traditional lending. Again, use banks for your convenience, not use you for their convenience. Yeah, good question. Let's keep rolling. I'm going to show a second and third strategy, then we're going to be done and do some more Q&A and wrap up. So the second strategy is something called equity harvesting. This is a lot of fun. So the idea here is that you can flip your first property and use that profit for funding your policy. All right. Or if you don't want to flip, you can also just do a simple cash out refinance on some existing property you have and harvest out the equity. Why harvest equity right now? Guys, our home price is low or our home price is high right now? Depends on what part of the market you're in, I guess, but most people are seeing home values go up and even commercial go up. Will that be forever? Is that guaranteed? I don't think so. So what better time to harvest out some equity than right now? You're able to do that. And a way to fund your policy might be some of that non-guaranteed equity in your properties. The third strategy I want to bring up is something called the rental repayment strategy, where you can use your policy to purchase the property and then let the tenants pay off your policy loan for you. Imagine that. Just like a bank. Policies will continue to grow and you don't lose cash flow to make other investments in the meantime. So let's say you had a property you wanted to buy for $150,000. Let's say that tenant pays you $1,100 a month or $13,000 a year. They pay that policy loan off for you, and then you've got your $150 plus a lot more for your next property. Let's see what it looks like with some actual numbers, shall we? So let's say that, and this is a real life person. She put in a premium. Let me get my little drawing stick here one more time. She put in a premium of $150,000 right there, $150,000. Then immediately within 30 days, she took a loan for $120,000. She had one of those really cool downtown condos here in Chicago, and she bought another one out in the near suburbs for $120,000. So she had a additional premium that she dumped in. She did a cash out refinance and put the 150 into her policy. 30 days later, borrowed out 120 grand. Imagine how much cash you have right away. All right. Immediately, her new condo out in the near suburbs is worth 120,000. Plus, she still has the condo downtown. All right. And the new condo out in the near suburbs is going to cash flow $1,100 a month. Now, I'm going to assume that her condo's value never grows over 10 years. We're going to leave it alone at 120 grand. But she's going to take that $1,100 a month, that's $13,200 a year, roughly, and she's going to put that into her policy. All right. She's going to pay down that policy loan. And over the next 10 years, she'll pay off the loan, and she's got a total cash value of $164,000. And she sells her real estate, which is still worth only 120 grand, All right. So she's got the $284,000, which is a combination of the 164 in her cash value plus the 120 grand that her condo out in the near suburbs is worth. Plus, oh, and by the way, a death benefit on top of all that of 355,000 bucks. Tell me any better way to buy your real estate, right? Jay, any thoughts on that?
Yeah, I wish I would have done this sooner.
Yeah.
Hannah asked another question, really good question. You're talking about cash out refinancing and rental properties here. Can you roll in, let's say you have some rental properties now, can you roll those into a policy, have the policy pay those off, right? With the current payoff that the current mortgage they have with the bank? That makes
Yes, you
sense.
can.
Okay.
I believe so. I think I understood that. Yeah, you
Let
can.
me read it the way she typed it in. It'd probably make more sense.
Mhm.
Can you roll in your current rental properties, question mark, have the policy pay off your current payoff, right?
Yep. We call that the debt snowbank method of paying off your debts. A tip of the hat to Mr. Dave there, but the debt snowbank method is pack money into your policy, let your mortgage come down slowly, and as you please, you can wipe out debts one at a time. I may be answering your question, Hannah. If I'm not, I apologize. But the idea there is buying back your debt slowly and surely. This is how I paid off my student loans, by the way. Slowly and surely wiping out your debts and taking that asset back and getting the bank's debt off the balance sheet. And now you're just banking on yourself.
Awesome. Hannah, let us know in the chat if we need to add any more, or if Mark needs to add any more clarity to that one. I think it's a really good question. Something I have not thought about yet. So I don't know why, but Marcellus asked, can I use a strategy in conjunction with a self-directed IRA, or do those conflict?
No, they don't conflict. I wouldn't try to put a life insurance policy inside a self-directed IRA. You want to make sure, funny enough, Congress seems to put strict rules around what you can put inside an IRA, including self-directed. I'm not a huge fan of self-directed IRAs. Here's why. And I hope I'm not stepping on any toes here, but my biggest beef with self-directeds are I can't use it for my personal life. I can only use it for certain things. And one of the main reasons as you become more affluent in your real estate deals are the tax advantages of real estate. Incredible tax advantages, cost segregation, bonus depreciation. Tell me, are any of those available inside the self-directed IRA? No, unfortunately not. So when you use your policy, it's outside of the IRA, and you can use your policy for the tax advantages of real estate. And if you still have a self-directed IRA, that's fine. We can still play nice together. I'm still, looking at this from a holistic standpoint, and there's reasons to have money in government-sponsored retirement accounts. For example, if you need to cover the potholes in Chicago, I will gladly allow you to pay the taxes of our city and our country. So that's fine. But that's how I would use it. I would use the SDIRA for things that you just can't get the money out of that IRA till you're 60. And I'd use the life insurance as a way to do money and deals that might be more tax advantaged and keep that money liquid and rolling.
And can you take a self-directed IRA and help fund your bank on yourself policy?
Yeah, a couple of great ways to do that. I'll keep it brief for this call, but think of it this way. We got 2 more weeks of 2020. And if you've been impacted, God forbid, I hope no one has here, but if you've been financially or health-wise been affected by the coronavirus, the CARES Act allows you to take money out of 401ks and IRAs without early withdrawal penalty. And they give you 3 years to pay your taxes, not one. Never let us do this before. It's like a get out of jail free card for your cash, up to 100 grand. Talk to a tax professional, of course, to talk about all the details. But very often we've had 50 plus clients do that this year, and they're putting that money into policies, which then they've got free forever. And under current tax law, there's no taxes due on the policies if you take the money out through withdrawals and loans. Never get taxed again. Pay our taxes now while they're historically low. That's kind of my philosophy. But that's one way to do it. Another guy who got an inherited IRA from his dad, passed away. He's going to take the forced savings plan, the forced distributions on that IRA. You have to pay the taxes on your IRAs that you get inherited to you. he got a $500,000 inherited. He's going to have to pay taxes on that money at 50 grand a year, has to come out of that IRA. He has to pay taxes on it. He doesn't want the money, doesn't need the money, but he has to take the money out over 10 years. Guess where it's going? It's going into a life insurance policy year after year. After tax money goes into the policy, never get taxed again under current law. And it's been that way. Current law has existed for as long as we've had an income tax on life insurance. That's a great way to fund a policy. If you have to take money out of the IRA, great way to leave it into the policy so it never gets taxed again. Ready to keep rolling? Should we keep rolling, or is there other questions? Nope, you're muted, my friend.
Keep going. I know we'll wrap up here in the next 5 or so minutes. Sound good?
Sounds great.
Okay.
Good. Let's keep rolling. So, guys, there are 400,000 life insurance agents in this country. 400,000. Jay, that's one agent for every 800 or so Americans, if I'm doing my mental math right. That's a lot of people. And I bet even some people have had their life insurance license over some point of their life. They probably got recruited at a chicken dinner type arrangement. And maybe you sold your brother and sister and that was it. And so move on. But John says, I was one of them. LOL. That's fun. So there are only 200. Let me get back to sharing my screen here. There are only 200 Bank on Yourself professionals who know how to design these policies correctly. I gave you guys a list of about 7 or 8 characteristics that insurance companies, we need them to have mutual ownership, dividends that have been paid for every year over the last century. I want to know how they played out the last pandemic we went through as a country. I need to know that the companies have non-direct loans. There are literally, I gave you a couple right there, but there are literally 30 different points and characteristics. I kind of liken it to the USDA organic seal on my produce or food or whatever. I don't want to get just all natural granola if I'm going to be a hippie about it. I want organic granola because I know that it's meeting certain standards. And similarly, a Bank on Yourself professional meets a certain standard. We had to go through some significant training and credentials to earn that title. It took me about 3 years of mentoring to get that title, about as hard as my CFP or even harder in some cases to earn that credential. So you don't want to end up with a big influencer, as I call it, or a YouTube advisor, or, hey, I just Googled this right after Jay called or right after Marcellus called me. I'm going to Google this. You don't want that kind of insurance agent helping set this up for you. So you want to really make sure that you're getting at least a second opinion. And I'd be honored, Jay and I would be honored to sit down and chat with you about this, to let you know whether or not you've got a policy set up like this. I've seen people who thought they had Bank on Yourself type policies, ended up they were, tied to the market or increasing in cost every year. So you really want to do this right. It's just like a smartphone or a sports car. You really want to make sure they were engineered correctly from the beginning. Once it's engineered correctly, you just use it. It just works. But you really want to make sure you're working with a competent professional from day one. So I put the right link on the page. What do you know, Jay? Anything? I'm all set here, my friend.
All right. So
what else would you like to share?
I'm going to share my screen real quick.
Yeah.
I'm going to share some resources, just some things that we talked about today. And then there's a couple more questions that have come in with this. If I can figure out the whole sharing link here. I'll do this. Share. These are just some resources for today, right? Is we talked about, and there's a lot of Q&A or a lot of questions that came to me directly of how do we get in touch with Mark? w2capitalist.com/bank is one of them. And Mark, I'm going to give you one question here in just a minute. And guys, as you're going through this, or I'm going through this list, if you have another question, let me know in the chat or in the Q&A in particular, so we can make sure we get those answered for you. But you've heard me mention a lot about the W2 Capitalist Mastermind. We hang out every Wednesday at 6 o'clock. You're invited to come hang out with us at a happy hour. It's a virtual happy hour. It's very much like this. It's over Zoom. w2capitalist.com/happy hour is where you can sign up. It's free to attend. And it's basically just a networking event with me and the other members of the mastermind. Also, as you may have saw, depending on when you join, there were some areas at the very beginning where I said this is the webinar series. So I'm going to start giving you one of these once a month, and you can find out all the details at w2capitalist.com/webinars. And then of course, there's the link for the mastermind and for the events calendar, which host all of the events that come up here as well. So, Mark, it looks like you answered Hannah's question, but I want to ask it just in case anybody else has the same question. But you talked about using flip profits to fund a policy. Is what your fund the policy with considered tax free? Can you continue to add more to the policy at a later point in lump sums?
When we put money into a life insurance policy, it's a lot like a Roth IRA. So the money goes in after tax. So by putting proceeds into a policy from a flip, if there was a profit, you'd pay a capital gains tax on that flip. The good news is that's in a after-tax pocket for the rest of your life, meaning the growth of the policy grows tax-free for the rest of your life, and you're not in a ticking tax time bomb known as a 1031. All right. So we all love those 1031s for the time being, but as soon as the piper comes time to get paid, things get really hairy. I've seen a lot of people lose a lot of real estate deals, and or they buy real estate deals at a higher and higher price because they're forced into that 1031 trap, I guess. It's great for the time being, but the word is deferral with 1031 exchanges. And just like a root canal, I don't want to defer something like taxes. It only gets worse.
Yeah.
So that's my quick answer.
Oh, I love that. And I've done two 1031s. One was a successful exchange. The other one I let expire because, like you said, prices were just crazy. And I was like, I'm not doing this just because I'm being forced to. I did not like that at all.
Good man. Nothing wrong with 1031s when they make great sense. You just don't want the tax tail to wag the dog.
Todd Helzer asks, do you foresee any of the tax laws changing that would affect this strategy? What are the risks?
Hold on, my crystal ball, just a minute. I'm just kidding. Yeah. I'm just kidding. No, we just had the biggest tax overhaul in a generation. We had that 2 years ago. And there was no change to life insurance taxes. And by the way, there never has been really. There was one in the 80s, but importantly, all the people who had life insurance before 1988 got to keep the old tax law. So Jay, one more reason to get started now is get this policy started. Yeah, and get grandfathered in. Exactly.
By the way, you and Todd share the same barber, I think.
Right on. Hey, he doesn't cost a lot.
Yeah. Yeah. What else, guys? Anything else?
He doesn't do a very good job though. So.
All right, Mark, I appreciate your time very much. It's just, guys, if I can stress anything at this point in time, don't do like I did and wait a decade and kick this stone down the road. Start now. And here's the thing, you don't have to start with, like we did. So I, if I remember the numbers correctly, I should. So our annual premium is 25 grand for a policy on me, and then 5,000 for my wife. That's just the way we work that out. Right? Per year. Yep. And then, but you don't have to start there. You can start with $100, $500, 1,000, whatever the case is, 10,000. And then if you say, hey, I'm really liking this makes total sense. And now I've done good with my flipping, my rental properties are doing really well. I want to do another policy. One thing I don't remember you touching on is that you can have multiple policies on yourself. You can add additional policies later on, right?
Yep. Mm-hmm. Correct.
So,
yep, that's right.
Guys, I just want to encourage you, get on the phone with Mark. I think when you have that conversation with him, he's going to challenge you to think about things a little bit differently. Matter of fact, when Cassie and I got on the call with you, then it actually gave us some time to talk and there were some things that she was thinking about and some things that I was thinking about that we had not come together and talk about, and it all came to head. Right. And we're like, oh, well, let's talk about this. Let's definitely talk about that. What Hannah asked, what's the benefit to multiple policies on yourself?
When God's making it rain, you want more buckets out there catching what he's dropping. Every policy has a maximum to design it tax free. We have a lip on that bucket. There's a kind of a maximum you can pack into one particular policy. So, like I said, my first two policies, I only could do $500 a month per policy. That's still the maximum that the first two policies can take. I wish I had made that bigger from the beginning, but the good news is you can have more than one policy. So now we've got close to, let's see, we've got 10 accounts from various insurance companies. And that's why we create a portfolio, each one kind of does a different thing.
John asked, Jay, are you an agent for this now? And so part of the sponsorship, Mark and I were dividing it up several different ways. And I was like, you know what? Now that the light bulb is on, I truly believe in this. So yeah, I went and took my test. And I don't know if I'm incorrectly or correctly calling you my broker, but that's the way I look at it. Cause that's the way, I feel like I am an agent for you. So, so yeah. John, that great question. So that's how we formalize this sponsorship, but it's not because and just to show you how much I do believe in it and taking the extra mile.
Yeah.
I went and studied for the course. I went and took the test, passed it on the first try. I was pretty excited about that.
There you go.
And I'll have the continuing education to do, going forward. So
and I'll add to that too. I'll add to that too. All of the expenses, fees, commissions, whatever are paid to Jay or me are fully disclosed. As a certified financial planner, I'm supposed to do that. But the good news is life insurance companies disclose every last dollar of expense and all the growth that comes with it. I wish a mutual fund would do that. I wish my real estate would do that. I can't know when that toilet's going to break at the rental property down the street, or what the expense will be. So I do know we've kept you guys a few minutes late here, but yeah, it's a great question.
Yep. Absolutely. All right, guys, if you have any questions for me or for Mark, best way to do is to go to w2capitalist.com/bank, fill out the form. Both he and I will both receive the email notification that you filled it out. And then you'll get an opportunity to schedule a time with him for that free 15-minute consult. And it's gonna blow your mind once you get into the details of this. I promise you that. The only thing I want to encourage you, once again, I'll leave you guys with this. Don't do what I did and be sitting here 10 years from now. Man, I wish I would have started. That's been my biggest regret. So anyway, do it today. Go ahead and get some time on his calendar. And guys, thank you for attending. Thank you for being here all the way through. Mark, I will talk to you very soon, sir.
Awesome. Happy holidays. Happy New Year, guys. See you soon.
See you, buddy.